And for more on the markets, let's bring in Thomas Hayes. He's chairman and managing member at Great Hill Capital. Thanks for joining us, Thomas. So it's all about how high can the Fed go and how long can these high interest rates stay at these levels. But for every time that these interest rates go up, it makes it more expensive for the U.S. government to pay their own debt. So how do you think this will continue, and can the Fed sustain at these levels?
Yeah, well, Sarah, thanks for having me. As Winston Churchill once said, generals are always prepared to fight the last war. It's interesting. September of last year, 2021, when the GDP estimates for this year were plus 3.8%, PCE inflation was at 4.2%. They said inflation was transitory and they thought it made sense to have a Fed funds rate at 10 basis points. Now that inflation is actually rolling over, commodities are rolling over. We've had 2 quarters of negative GDP. We're probably going to have a 3rd quarter of negative GDP, meaning we've got the recession in the rearview mirror. Now they think it makes sense to have the Fed funds rate at 4.6% by early next year, which makes absolutely no sense. So they're going to have to walk this back. They just don't know it yet. And Sarah, they're going to have to walk it back for 3 reasons. Number one, as we know from commodities and the most recent 3 inflation prints since June, inflation is rolling over. But as you said, every 1% hike in the Fed funds rate, that's going to add $285 billion a year to the U.S. deficit just on interest payments. And for those who think that he can be Paul Volcker like in 1980 to 1982, U.S. debt to GDP back then was running at around 30%. So he could hike rates as high as he wanted to. We're running at 122% right now. You don't have that much latitude. So their playbook has been, let's talk hawkish and act dovish. They're only at 3.08% on the Fed funds rate right now. Chair Powell is scheduled to do a prepared speech on Wednesday. We'll see if he takes that opportunity to walk things back a little bit. And as you pointed to, a lot of things are starting to break, with the British pound, with the euro, with Italian bond yields at 9-year highs, with the ECB having to go into the market again with quantitative easing to start to buy those Italian bonds to contain things. I think at this point, it might be the sensible place to see a little bit of a walk back this week.
Is there a turning point up ahead, Thomas, that you are expecting when that walk back will actually happen?
It's just a question of how much pain they can take. So, if it comes this week or if it comes in 2 months, eventually the credit markets always discipline the politicians and the policymakers. And when governments, municipalities, and companies can't refinance, they will step in. Hopefully, they'll be a little proactive and see that happening because they've been successful. If you look at 5-year inflation break-evens today, and that's what they want to anchor is inflation expectations more than current inflation. They've collapsed from 3.59% in March to 2.38% today. That's a 15-month low in inflation expectations. So they've achieved a lot of what they want to do in terms of expectations. Now they have to be careful that they don't throw the global economy off a cliff, and they're pushing right up against it. So we'll see if they walk it back in time or if, like 2018, Chair Powell came out and said that he was going to put quantitative tightening on autopilot, and he crashed the market 16.5% in a few weeks before he walked it back the next week. And then the market made new highs a few months later. But I think, most managers right now, if you look at the data, Sarah, they're already positioned for the apocalypse. So any good news, whether it's earnings season coming up in a couple of weeks, expectations are very low, just like they were in June. And then we got the summer rally, or if it's a walk back, et cetera. There's a lot of cash on the sidelines that's going to be forced to chase into the market and panic buy higher if we get any bit of good news. And right now, no one's positioned for good news, and that's often when it happens. Recession expectations are the highest they've been since April of 2020. If you remember, the bottom of the market was the month before, and before that, March of 2009, when the bottom of the stock market was already in. So pessimism is palpable, and usually it pays to take the other side of that trade, start to ease in with high-quality businesses that are on sale, and then as things, as the waters become more calm, you can increase position sizing.
But before I let you go, Thomas, do you think this sell-off is very much different from the ones that we've seen in the past, especially after that rally that we got in the past few years? This is not something investors are used to seeing.
Yeah, I think that the pain trade moving forward based on positioning and based on some things that could potentially go right is going to be upward before year end. We're in a period of seasonal weakness, Sarah. September is the worst month of the year. This week is the worst month of September. So this is the weakest month of the year seasonally. So whether it's a walk back, whether we get some positive earnings that beat expectations, bullish boost, despite all the pessimism that we're seeing right now, I think potentially better days are ahead. Whether it's in coming days or coming weeks, we'll find out soon enough.
And we'll have our eyes on that, Thomas. Thanks so much. Thomas Hayes there, Chairman and Managing Member at Great Hill Capital.